Hello and welcome back to Invest with King. Warren Buffett has always been known for his long-term investment approach, rarely making drastic changes to his portfolio. He has historically advised against market timing and short-term speculation. However, recent actions by the legendary investor suggest he may be bracing for something significant. His current cash holdings, as a percentage of his portfolio, are at their highest level since before the 2007 financial crisis. Additionally, Buffett has made uncharacteristic moves, like selling 2/3 of his Apple shares, his largest single stock holding, and reducing his stake in Bank of America. Given that Buffett typically avoids short-term trading and holds stocks for decades, these decisions have raised eyebrows. Some wonder if he is simply making tax-efficient moves or if he sees a storm on the horizon. To understand his actions, we need to analyze some key economic indicators that could influence market movement. One of the best ways to assess stock market valuation is by looking at the price-to-earning ratios of the S&P 500, which includes 500 of the most influential U.S. companies. The P/E ratio measures how much investors are paying for each dollar of earnings. Currently, the S&P 500 has a P/E ratio of 30.6, meaning that stocks are priced at over 30 times their earnings. Historically, the average P/E ratio has long been around 16, suggesting that today's market is almost twice as expensive as the long-term norm. This high valuation increases the likelihood of a market correction. Buffett himself has highlighted a particular metric as a key gauge of market valuation: the ratio of total U.S. stock market value to the country's gross domestic product. This metric, commonly called the Buffett indicator, categorizes the market into different valuations: below 84%, significantly undervalued; 84 to 108%, moderately undervalued; 108% to 132%, fairly valued; 132% to 156%, modestly valued; above 156%, significantly overvalued. Currently, the Buffett indicator sits at an astonishing 211%, far exceeding historical levels. And to put this into perspective, just before the 2007 crisis, this indicator was only 105%, and before the dot-com bubble burst in 2000, it stood at 138%. This study suggests that today's market is more overvalued than during the previous stock market crashes. For the past 4 decades, the stock market has enjoyed a mostly uninterrupted rise. While there have been occasional downturns, the long-term trajectory has been overwhelmingly positive. A major factor behind this trend has been the steady decline in interest rates since '81. In 1981, U.S. interest rates were as high as 19%, but they've fallen to nearly zero in recent years. Buffett has likened interest rates to gravity for stock prices. When rates are low, stock prices face little resistance and can rise freely. However, when rates increase, the gravitational pull on stock prices strengthens, making it harder for them to maintain their upward momentum. Recently, interest rates have started to rise again, which could put downward pressure on stock prices. The Federal Reserve, led by Jerome Powell, has signaled its commitment to keeping rates elevated for the foreseeable future. If rates remain high, stock valuations may be at risk of significant decline. Another important indicator to consider is the yield curve, which has historically been one of the most reliable predictors of recession. The yield curve measures the difference between short-term and long-term interest rates. When short-term rates are higher than long-term rates, creating an inverted yield curve, it often signals that a recession's on the horizon. The yield curve has successfully predicted every U.S. recession since 1969, including the 2008 financial crisis. Currently, the yield is experiencing one of its deepest inversions in decades, reaching a low of negative 1.88. This is even more extreme than the inversion seen before the 2008 financial crisis. Historically, once the yield curve starts to recover from an inversion, a recession typically follows within 6 to 18 months. Another factor to consider is the job market. Unemployment tends to follow a cyclical pattern with long periods of gradual decline followed by sharp increase. Right now, the U.S. job market has been in a prolonged period of low unemployment, but there have been recent signs of an uptick. If unemployment continues to rise, it could signal broader economic trouble ahead. Additionally, S&P Global uses 9 leading indicators to assess the likelihood of a recession. Currently, 4 of these indicators are flashing red, including 1. Term spread, 2. Consumer sentiment, 3. Manufacturing new orders, 4. Bank lending practices. Consumer sentiment in particular has recently turned negative after being positive for several months. Many consumers are growing increasingly wary about economic conditions over the next year, largely due to persistent interest rates. Given these warning signs, should investors start selling their stock and preparing for a crash? Historically, Buffett has advised against trying to time the market. He has often warned that waiting for a downturn before investing can lead to missed opportunity. For example, in 2018, many investors believed the market was overvalued and were cautious about investing. However, stocks continued to rise in the following years, proving that staying invested is often the better strategy. Buffett has repeatedly emphasized that trying to predict short-term market movements is futile. Another key lesson from Buffett is the importance of holding stocks for the long term. Many of these successful investments, like Coca-Cola and the Washington Post, have been around for decades without being sold. This approach minimizes capital gain taxes and allows for the benefits of compounding. As Buffett's longtime business partner, Charlie Munger, once said, "The big money is not in the buying and the selling, but in the waiting." Buffett has also consistently emphasized the superiority of owning businesses over holding cash. While cash loses value over time due to inflation, businesses generate profits and grow in value. Despite this belief, however, Buffett's actions suggest he is currently seeing limited investment opportunities. Why is Buffett selling now? Instead of following his usual strategy of holding stocks indefinitely, Buffett has been selling large portions of his portfolio. His most surprising move was selling 2/3 of his Apple shares, a position he had maintained since 2017. Buffett has explained this decision in a recent shareholder meeting, citing tax considerations. Currently, capital gains tax at a relatively low 21%, he believes that may increase in the future due to the U.S. government's fiscal policies. By selling now, he can lock in lower tax rates on his gains. Additionally, Buffett has dramatically reduced his exposure to the banking sector. He has sold billions of dollars worth of Bank of America stock, mounting to 26% of Berkshire Hathaway's stake in the company. This follows his decision to sell another major bank stock, including Wells Fargo, Goldman Sachs, and JP Morgan Chase. Buffett has held some of these stocks for over 25 years, marking this as a significant shift in his strategy. After these sales, Berkshire Hathaway now holds over $325 billion in cash, more than the entire GDP of countries like New Zealand, Portugal, and Chile. More importantly, cash now makes up 50% of Berkshire's holdings in U.S. publicly traded stocks, a level not seen since before the 2008 financial crash. Even before the dot-com bubble burst of 2000, Buffett was not holding this much cash. While he maintains that cash is a poor long-term investment, Buffett has stated that he prefers to keep ample reserves when he sees a few attractive opportunities in the market. So, is Warren Buffett predicting a market crash? While he's never claimed to have a crystal ball, his recent actions suggest that he is taking a cautious approach. Market valuations are historically high, interest rates have risen, and recession indicators are flashing warnings. Buffett's decision to sell stocks and hold record levels of cash suggests he may be positioning Berkshire Hathaway to take advantage of lower prices in the future. For everyday investors, the key takeaway is to remain disciplined, avoid market timing, and consider long-term strategies. While a downturn may or may not be imminent, Buffett's actions signal that now is a time to be cautious rather than for aggression in the market.